all of which are about to experience S-curves and feed one another's S-curves. I don't think the market's ready for this. We've dedicated our research and investing to innovation because we think we've never been at a more provocative time for innovation in history.
A lot of challenges that are ahead of us, not the least of which is Fed tapering. You also have a budget, which will likely include tax increases. And you clearly have higher inflation. I think the goalposts on inflation being transitory were moved from earlier this year, where it was considered to be a couple-month phenomenon.
Hedge funds jumping ship, investors, including Michael Burry, placing millions of put contracts against Cathie Wood's Ark Innovation ETF. The fund grew a whopping 149% in 2020. This year down just about 6%. She hit back, said Burry doesn't understand the explosive growth in innovation investing right now. Ark Invest founder and CEO Cathie Wood joins us here on Tech Chat this morning. Cathie, always good to have you. Thanks for the time. So let's talk about the short community at large. What is your message to them right now?
Well, you know what, when I see such negative sentiment out there, especially when it comes to valuation and longer time horizons, investment time horizons, I actually feel a little more comfortable. I like bad news and maybe news that's not, the discounting is worse now than the news actually will be. I actually feel better in that kind of environment for our strategies. I don't think we're in a bubble, which is what I think many bears think we are. In a bubble, and I remember the late 90s, our strategy would have been cheered on, rah, 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 go get them, right? And you remember the leapfrogging of analysts making estimates, one higher than the other, price targets one higher than the other. We have nothing like that right now. In fact, you see a lot of IPOs or SPACs coming out and falling to earth. We couldn't be further away from a bubble. And the reason for that is the innovation around which we have centered our research. These 5 platforms, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, are barely off the ground. The seeds for all of these platforms were planted in the 20 years that ended in the tech and telecom bust. And ended in tears, and there's a lot of muscle memory around that. But that's not what's going on right now. The seeds planted back then are beginning to flourish now, and it's just beginning with 5 platforms involving 14 different technologies, all of which are about to experience S-curves and feed one another's S-curves. I don't think the market's ready for this. That's what I meant. We've dedicated our research and investing to innovation because we think we've never been at a more provocative time for innovation in history.
And I do want to get to how some of those forces are playing out on your macro thesis, which you've talked about a lot in recent months. But as far as the shorts go, in terms of how they have their eyes set on Ark specifically, is it just, do you think, is it general macro bearishness, or does it have something more to do with your ability to analyze all these companies that you're now in and stay on top of that game?
I actually think it's more of a macro call. When I read the bearish analyses, they seem to be centered on inflation and interest rates going higher, which will kill valuations. And if anything, as you mentioned, Carl, we're focused on the deflationary forces that are building up in the economy. And I think that's going to be the shocker out there, that deflation is the greater risk now, not inflation. And not all deflation is bad. There's really good deflation associated with these technologically enabled platforms. They follow learning curves, which are characterized by declining costs and prices, and enables more and more sectors to have access to these powerful new technologies. So that's good deflation. The bad deflation is going to be associated with companies who paid too much attention to short-term oriented shareholders who wanted their profits now, wanted their dividends now, and did not want companies to sacrifice short-term profitability in order to capitalize on some of these massive trends that we see building. They are going to be stuck with obsolete products, and yet in the meantime, they've leveraged up their balance sheets to buy back sales and satisfy short-term oriented shareholders. How are they going to service that debt? They're going to have to cut prices of these products and services that are not going to be as popular in the future as they have been in the past. And then the third source of deflation, which is really starting to come through now in a noticeable way, started in mid-May, when lumber prices broke. We're seeing commodity price deflation. We've gone from, lumber prices have been cut to less than one third of their peak, 1711 to 500 right now. You've got copper down roughly 15%, 15 to 20%. You now have oil down nearly 15 to 20%. And I think the cream of the crop here, and the reason this may be happening and may accelerate to the downside, is the dollar is going up. And that, of course, might be associated with what's going on in China.
Commodity prices before, and I wonder if you're willing to mention any of the companies or industries that you're referring to, those that are perhaps sacrificing those long-term innovations that you're not a fan of.
Well, I think that if when we look at the S&P 500, for example, we think that because of technology changes and importantly, that a lot of industries are in harm's way. Energy certainly is. Because of electric vehicles and the move towards autonomous electric. And you can throw in autos and and the auto supply chain. They're scrambling to try and get into this new world. It's going to be very difficult. Even when you think of retail, many investors, I'm sure, think, okay, well, we've seen the destruction there. We think it's just begun in a way, because online retail sales have only hit 20% of total sales here in the United States. When a trend moves from 10 through 20%, it's usually moving into overdrive. So we think a much higher percentage of sales will be online. So even retail and any business that can be done online. Financial services, I would say digital wallets, DeFi, a big problem, a big challenge for financial services.
Right. And Cathie, a few moments ago, you talked about the innovative way that you guys at Ark structure your research. And I wonder, what does someone shorting Ark miss about your approach, the advantages or perhaps the differences of being an ETF versus, say, a hedge fund?
I don't think the wrapper matters that much. I think our research is the differentiator. And the way we've set up our research department is a differentiator. Unlike traditional asset management firms, our analysts do not follow sectors. They follow technologies, the 14 different technologies that I mentioned involved in these 5 major innovation platforms. So they are technology specialists, and they are generalists when it comes to sectors. So we have a very good idea based on our analysis of these technologies and Wright's Law. Wright's Law, we've centered our research around it. Wright's Law is a relative of Moore's Law. But Moore's Law is a function of time. Wright's Law is a function of units. And Wright's Law has worked better in the semiconductor industry recently than Moore's Law has. So we think that's a very important gauge of how quickly these costs are going to decline over time. And we also pay a lot of attention to price elasticity of demand. At what point in this cost or in price decline trajectory will new sectors open up to these new technologies? Gas-powered prices in a year or so, they're already lower from a total cost of ownership point of view. So we think that 2.2 million will be 40 million in 5 years, in 2025, not even 5 years. No one is forecasting that. So the starting point from the top down, using Wright's law, getting a sense of how quickly the costs associated with these technologies are falling, and how quickly, therefore, they will be taken up by more and more sectors and industries over time.